Hey guys, lately YouTubers are making calls to ditch Bogleheads 3 fund portfolio. Instead, they advocate keeping the magic number 3, but replace bonds and international stock funds with something else. And that something else is what I want to zoom in on today. The thing is that modifying 3 fund portfolio from Bogleheads is not exactly costless. It comes with its own trade-offs. So in this video, let's shine the light on the pros and cons of this new 3 fund portfolio from social media. Here's one popular video from Nolan Gouveia, also known as Professor G, on this. It gathered over 1 million views. Here's his take.
You've probably heard of the 3 fund portfolio before, but it's likely the old version from the 1990s, and unfortunately a lot of people still follow that one, and it's literally leaving hundreds of thousands of dollars out of their portfolio. Switching up at least 2 of the funds to the more updated version that makes a lot more sense nowadays in 2024 is going to be your best bet.
If we look at standard Bogleheads 3 fund portfolio, it allocates investments between stocks and bonds through index funds. Bonds are represented by the total bond market ETF like Vanguard's BND. It provides exposure to investment-grade US bonds. Some suggest throwing foreign bonds into the mix too, but hold your horses, now we're pushing into the 4 fund territory. As for the stock allocation, it goes into domestic and international equities. Vanguard Total Stock Market Index ETF or VTI is a gold standard for domestic allocation. As for international stocks, Vanguard VX US is Boglehead's all-time favorite for that. Now, what does Nolan Gouveia suggest? Here are his words.
So this first category, this is the only one that's actually going to stay the same from that old 3 fund portfolio, and this is the foundational ETF. Now that old 3 fund portfolio put safety within the portfolio by advocating for bonds. My new 3 fund portfolio changes this thinking up while keeping it very safe by investing in a dividend ETF. So back in the day, this category was the international category. Instead of international, this new 3 fund portfolio has a category called growth ETF. These types of ETFs hold very technologically advanced companies that are supposed to grow way faster and larger than normal companies.
So to recap, Nolan suggests to keep the total stock market fund in place, but he suggests to replace bonds with a high-yield dividend fund like SCHD. Also, he gets rid of international stock exposure, and instead he replaces it with US growth stock funds like Vanguard's VUG or QQQ that tracks Nasdaq 100. So effectively, this turns Boglehead's 3 fund portfolio from a mix of bonds and stocks into an allocation that focuses 100% on US stocks only. Here's his argument in favor of doing so.
The international ETF VX US has brought about 4.6% appreciation on average each year over the past 10 years. That's pretty bad, especially since this is the one that should have the highest appreciation because you're dealing with the most amount of risk and possibility that you actually lose money.
That's true indeed. If we look at VX US fund, it lagged the S&P 500. That's sad if you have held foreign equities and watched the US stock market powering ahead. The same thing goes for bonds. Bonds' total return performance has been lackluster too. For instance, Vanguard Bond Fund is down by over 3% for the past 5 years on a total return basis. Conversely, SCHD did well over the last 5 or 10 years, as we see here. But here's my main counterpoint to Professor G's argument. What he showed us is the last 10 to 15 years and how his 3 new fund portfolio would have done so much better. The problem is that the last 10 to 15 years are exceptional. We are amid one of the longest bull markets for US equities. Thanks to tech, US stocks outperformed pretty much any other foreign stock market. A similar argument goes for bonds. The last 5 years have been terrible for fixed income securities. And the reason? The Federal Reserve has been raising rates since 2022 to fight inflation. So of course funds like BND did not do so well, as we see on this graph. Why am I pointing out this time horizon problem? Because it's easy to say that this time is different, and now we are starting to fall into the recency bias territory, which says that things of recent occurrence will continue for sure into the future. But they may not. Let's start with international stocks that Professor G proposes to get rid of. Yes, that's true that foreign equities underperformed the S&P 500, but the thing is that this underperformance has not always been there. If we look at this graph, we see that international and US stocks trade the top spot for returns. Sometimes US stocks do better, sometimes they don't. If we were talking back in 2011, we would cry over how US stocks did worse. But we don't have to go far either. Take the last 6 months. The S&P 500 underperformed international stocks ETFs by a wide margin, almost 12%. Either way, the fact stays the same. Outperformance comes and goes. But what if diversification is one of your main goals? Then having international stock exposure makes perfect sense in a very long run. Another Professor G argument in favor of dropping international stocks is this. Many companies in the US, like in the S&P 500, derive a large share of their revenues from abroad. By some estimates, S&P 500 companies derive close to 40% of their sales from overseas. I totally see where he's coming from. But here's the problem. Many times, S&P 500 stocks will still behave like a typical American stock, and it may not even matter where sales are coming from. Conversely, foreign stocks can and do perform differently from their US counterparts. And that's very valuable for having uncorrelated returns in your portfolio. Also, by going all in on US stocks only, you will not hold some of the leaders in certain sectors that are residing outside of the US. And among these companies are ASML, Taiwan Semiconductor Manufacturing Company, and many others. Finally, foreign stocks can provide valuable sector diversification. International equities tend to be value-oriented with higher allocations to financial and industrial sectors. Right now, the US stock market is overweight on tech, but if tech performance slows down, the tail can wag the dog. To be fair, Nolan believes that US equities will outperform everything else, and he especially likes American growth stocks. I don't see anything wrong with that. I mean, if that's someone's view, then allocating more to US stocks and growth stocks makes sense. But be aware that Professor G is a young 35-year-old investor who has many years before his retirement, at least 30 based on what he says in his video. So with a strong conviction in US stocks and a very long time horizon, makes sense. I can see why he wants to go all in on US stocks. If you're older than him or you're approaching retirement, then 100% allocation to stocks makes very little sense. Of course, things will depend on the size of your nest egg. If, let's say, I had millions of dollars in my retirement accounts, I would allocate more to stocks, unlike what the common advice says. Take for instance Warren Buffett. He probably gave a large inheritance to his spouse. For this reason, he went with a two-fund portfolio. 90% of all assets went into the S&P 500 fund. The remaining 10% sits in bonds. Bonds alone will probably produce income enough to cover his wife's living expenses. The remaining 90% in stocks will continue growing. So, of course, allocating more to stocks makes sense in his case. Next, let's address another thing that Professor G recommends, and that is to replace bonds for a dividend fund. His top choice is SCHD. Why would he suggest that? His argument is that SCHD did so much better on a total returns basis since inception. On top of it, SCHD's dividend distributions per share have increased more than 3 times over the last roughly 12 years. If we compare bonds and dividend funds like SCHD based on a distribution yield, I can see where he's coming from. Yield on cost is a metric that shows how your yield would change on your original investment. For the bond ETF, it got nowhere over the last 18 years. Conversely, SCHD yield on cost more than tripled. Its price appreciation has been strong too. On a total return basis, SCHD smoked any bond fund you will look at. But is this really a fair comparison? Bonds and stocks are two different classes and they behave differently. And that's exactly the reason why Bogleheads want bonds in their portfolio. If we look at rolling correlation between bonds and stocks, it's mostly negatives. This has been true since the early 2000s. Bonds were especially helpful during the great financial crisis of 2008. Holding bonds from 2008 to about 2012 would have saved your portfolio from a total disaster. Of course, the correlation is not negative all the time. There are episodes when it was positive. This was true when inflation expectation spiked or an economic crisis happened. Bonds, especially corporate ones, can sell off along with stocks when times are bad. And that's when investors get concerned about companies' credit worthiness. But either way, bonds are a useful tool to help you diversify your portfolio. They can offset underperformance of stocks. Be aware that high allocation to stocks will introduce more risk into your portfolio, and there is no better chart than from Vanguard that illustrates this concept of risk-reward relationship. Over the last almost 100 years, this is how different allocations of bonds versus stocks performed. With 100% allocation to bonds, you would earn on average a respectable annual return of 5%. Bonds tanked by 13% in their worst year, but grew by almost 33% in their best year. But what about 100% allocation to stocks? On average, they grew by about 10.5% a year. That's 2 times more than bonds. In their best year, stocks got 54% gain, which is 1.5 times more than bonds. But in their worst year, stocks lost 43%, which is over 3 times more than bonds. So, with higher reward comes higher risk. On top of it, what this chart doesn't capture is that bear markets for stocks can last for years. And if you happen to sell your stocks to fund your retirement in those years, that could be bad news. SCHD behaves like any stock fund. It will go down when the broad stock market tanks. Sometimes it could be in double digits. If you have sufficient capital to live off SCHD dividends, then that's not a problem. Although keep in mind that dividends per share can go down for SCHD when times are bad. But what if you're relying on selling shares of your 100% stock portfolio to fund your retirement? That's not exactly the best scenario to find yourself in. I would say this: diversified stock ETFs with broad exposure rarely go kaput, and over a period of time they will recover their lost ground. So over a very long periods of time it may not matter, but sometimes it can matter, especially if you're approaching retirement. One thing that Nolan Gouveia or Professor G didn't tell us is how he would change this allocation when he actually retires. And to be fair, he rightfully points out that this allocation that he advocates in his video will not work for everyone. As people age, we tend to turn conservative and risk-averse. Chasing the highest return becomes secondary. Unless you sit on a huge pile of money, allocating more to bonds makes sense most of the time. That's helpful even if you're not in retirement, but getting near it. Finally, I want to point out another flaw in Nolan's approach to having a 100% allocation in US stocks with these funds. They will have overlap. For instance, take VTI and QQQ. They have 44% overlap. Also, VOO and QQQ have over 50% allocation overlap. As far as SCHD, its overlap with QQQ or VUG or VTI is quite minimal, below 10%. But anyways, having VOO, VTI or QQQ or VUG in his portfolio, Professor G will have a lot of overlap. And I'm not even speaking of correlation of returns among some of these funds in the realm of 70 to 90%. In other words, you'll be doubling down on certain stocks, and likely they will be tech companies. So you will get overexposed even more to risky growth. I mean, again, that's not a problem if that's your preference and you're young, but that's something that you should be aware of. Conversely, Bogleheads' 3-fund portfolio has zero overlap among its funds, and that feature is there by design to maximize diversification benefits. And Bogleheads' 3-fund portfolio may not produce the highest returns possible, but it may turn out much more resilient in times of stress. What if everybody panics and starts to sell their stocks like it happened in the late 2000s? Bogleheads' allocation to bonds can shoulder that pain, especially when it's most needed. On top of it, international stocks can outperform US equities like it happened lately, and that's another factor in favor of Bogleheads 3-fund portfolio. It is simple, but tested by time and solid research. Professor G approach may work. It is more suitable for someone young with a high conviction in US stocks. But things can and do change. There's one thing that I learned over all my years of investing, and it's good to diversify and spread your bets across different baskets. It may not seem appropriate when things are up and growing, but when things turn south, I wish I did something different in hindsight. You can learn why investing in international stocks makes sense by watching this video. I also made another video about Bogleheads 3-fund portfolio, linked here. And if you want to learn more about investing and economic topics in the future, subscribe to my channel for more. All the best!